Today, we embark on a financial detective journey into cost-volume profit analysis. Picture yourself unraveling how companies balance costs, activity, and profit to drive strategic decisions. This presentation introduces key managerial accounting insights, exploring how fixed and variable costs influence profitability. We will examine underlying patterns to reveal the true impact of each expense. In this segment, our learning objectives guide you from basic cost classifications to advanced profit calculations. You will identify variable versus fixed costs, calculate contribution margins, and compute break-even points with clarity. Each goal is designed to build your financial detective skills in understanding real-world business dynamics. As you progress, visualize each step through practical examples and straightforward formulas. Imagine investigating a case where numbers tell a story. CVP analysis is your blueprint, revealing how changes in costs and sales volume affect overall profitability. This method breaks down key elements such as cost behavior, production volume, and the resulting profit margins. With clear explanations and defined cards for cost, volume, and profit, you'll understand how each factor contributes to the bigger financial picture. Prepare to explore these concepts in depth right now. Delve into cost behavior, where variable and fixed costs reveal different patterns. Variable costs change with production levels while fixed costs remain consistent despite activity fluctuations. Cost classification is the essential first step, because CVP analysis depends entirely on separating variable costs from fixed costs. Variable costs determine the contribution margin per unit, how much each sale contributes toward covering fixed costs and generating profit. Fixed costs establish the hurdle that must be cleared before any profit emerges. If costs are misclassified, the contribution margin is wrong, which means break-even calculations are wrong, target profit analysis is wrong, and every decision based on CVP becomes unreliable. The entire framework rests on this one distinction. Mixed costs must be separated into their variable and fixed components before CVP analysis can work, typically using the high-low method for simplicity or regression analysis for accuracy. Step fixed costs, which remain constant within a range, but jump at certain volume thresholds, are usually treated as fixed within the relevant range of expected operations. These are necessary simplifications. CVP analysis assumes linearity and clean cost behavior that rarely exists in practice. The model remains a powerful decision-making tool, as long as you acknowledge its assumptions and stay within the relevant range where those assumptions hold reasonably true. Explore contribution margin as the heartbeat of profit analysis. This metric reveals the amount remaining after covering variable expenses. Through clear formulas and key insights, you learn that each sale first offsets fixed costs before creating profit. Visual aids like highlighted boxes and defined calculation steps simplify complex financial terms. By understanding concepts like sales deductions and ratios, you gain a powerful tool for evaluating business performance clearly and confidently to drive success. Consider TechGadget Incorporated, where smartphones illustrate contribution margin perfectly. Each $500 sale minus $300 variable cost results in a $200 contribution that not only covers fixed costs, but also fuels profit generation. Contribution margin tells you how much each unit sold contributes toward covering fixed costs and generating profit. Without it, you cannot determine how many units you need to sell to break even or hit a profit target. Now let's examine break-even analysis, where the puzzle of fixed costs and sales volume is solved. The method shows when revenue equals costs and profit reaches zero through two formulas. One in units and the other in dollars. Break-even tells you the minimum sales volume required to avoid a loss. It's the survival threshold that separates profitable operations from money-losing ones, and the baseline from which all target profit planning begins. Today, our financial investigation begins with a break-even example from TechGadget Incorporated. Picture fixed costs of $400,000 and a contribution margin of $200 per unit, leading to exactly 2,000 units, and a contribution margin ratio of 40%, confirming break-even sales of $1 million. Unfolding our mystery further, we explore a detailed CVP graph that plots total revenue against total cost. Notice the teal revenue line starting at 0, and the red cost line beginning above 0, influenced by fixed costs. A teal circle marks the break-even point. The CVP graph plots dollars on the vertical axis and units on the horizontal axis, showing 3 lines. A horizontal fixed cost line, a total cost line that starts at fixed costs and rises with variable costs per unit, and a total revenue line that starts at 0 and rises with selling price per unit. Where the revenue and total cost lines intersect is the break-even point. Below that volume you're in the loss zone. Above it you're in the profit zone, and the vertical distance between the lines at any volume represents your profit or loss. Our investigation now shifts to target profit analysis, where we calculate how many units or dollars are required to achieve a desired profit. Target profit analysis extends break-even by asking, how many units must we sell to earn a specific profit amount? You simply add the desired profit to fixed costs in the numerator, then divide by contribution margin, because that target profit becomes an additional hurdle the contribution margin must cover beyond just the fixed costs. Next, we examine the margin of safety, a critical buffer indicating how much sales can decline before losses emerge. Using TechGadget's example, the formulas in dollars, units, and percentage reveal the cushion above break-even. By comparing actual sales to break-even sales, you grasp the company's resilience in adverse conditions. This analysis is essential for understanding risk management in managerial accounting. This insight strengthens strategic planning, guides budgeting decisions, and enhances performance evaluation effectively. Unraveling operating leverage, we dissect how changes in sales profoundly affect net operating income. The formula, degree of operating leverage, divides contribution margin by net operating income. High operating leverage implies higher fixed costs and amplified risks, while low operating leverage indicates steadier profit margins with less dramatic reactions. Operating leverage reflects how much of your cost structure is fixed versus variable. A company with high fixed costs, like a factory with expensive equipment and salaried workers, has high operating leverage, meaning once you cover those fixed costs, almost every additional dollar of sales drops straight to profit. But if sales decline, those fixed costs don't go away and losses pile up quickly. A company with mostly variable costs, like a retailer paying per unit costs to suppliers, has low operating leverage, meaning profits grow more slowly as sales increase because each sale carries its own cost. But downturns hurt less because costs shrink along with revenue. It's the trade-off between risk and reward. High fixed costs create a steeper ride in both directions. Now we turn to multi-product CVP analysis, where a weighted average contribution margin becomes essential. A table listing standard and premium products demonstrates how diverse prices, costs, and sales mixes combine to yield a unified margin calculation of $168 per unit. This approach reveals the sensitive nature of a sales mix's impact on break-even points, urging careful adjustment of product strategies for enhanced profitability and competitive advantage in complex markets, driving smart, informed decisions. Finally, we review CVP assumptions that simplify our financial investigations. CVP analysis assumes a simplified world. Selling price stays constant regardless of volume. Costs behave linearly and split cleanly into variable and fixed categories. Sales mix remains unchanged if you sell multiple products. Everything produced gets sold with no inventory changes, and productivity stays constant. These assumptions rarely hold perfectly in reality. Prices often drop with volume discounts, costs curve at extreme volumes, sales mix shifts with market conditions, but the model remains useful within a relevant range of normal operations where the assumptions approximate reality closely enough for practical decision-making. Wrapping up our investigation, we highlight key takeaways: contribution margin, break-even point, target profit, margin of safety, operating leverage, and sales mix. Each concept is crucial, providing a framework for budgeting, pricing, and strategic planning. CVP analysis gives managers the ability to answer what-if questions before committing resources. What if we raise prices? What if volume drops 20%? What if we automate and trade variable labor costs for fixed equipment costs? What if we change our product mix? It transforms accounting data into a decision-making tool that connects operational choices to profit outcomes, helping managers understand the financial consequences of pricing decisions, cost structure changes, and volume targets without waiting until year-end to see what happened.